Hey there and welcome back to the channel. In this video we're going to be going over the latest earnings report of Fortinet. But they reported their Q3 earnings for 2023 a couple of days ago. Fortinet is a leader in the cybersecurity space and Wall Street was not happy with the results they reported. And the stock has been on a decline since July, going from $78 down to currently $50. Full disclosure on my part, I am a shareholder in Fortinet, and by the time this video gets released, I will probably have added to my stake. But you have to remember that this is not financial advice, and I would never recommend taking advice from anybody, especially some random guy on YouTube. It is pretty easy to borrow ideas, but I don't think you can ever borrow conviction. You have to do your own research, your own due diligence, because the stock market is a very volatile place. And once the stock starts going down, it's really tough for you not to sell out at a loss if you haven't done your own research. I've experienced that myself when I bought into Alibaba in 2021, where I borrowed the idea from Monish Pabrai and Charlie Munger. So you have to be really careful with who you take advice from, especially on YouTube, since it is a cesspool filled with people giving you bad advice. With that being said, before we get into it, I do want to ask you to smash the like and subscribe to the channel if you get any value out of the content that I'm providing. And I also want to ask you to comment below if you have an opinion on Fortinet or the cybersecurity space in general. Let's start off with the investor presentation for Fortinet, which is a really good document that I would recommend that you go through if you're thinking about investing in the company. Now, the Gartner Magic Quadrant shows you who the leaders are in specific niches within cybersecurity. And as we can see here, Fortinet is considered a leader when it comes to SD-WAN. Fortinet's biggest rival, Palo Alto, is also considered a leader, but is much lower in the Magic Quadrant than Fortinet. Fortinet is operating in a highly competitive business, but the total addressable market, the TAM, is huge, where they are expecting secure networking, which is currently a $62 billion industry, to grow at about 9% CAGR for the next 4 years. Security operations is a $46 billion industry and is expected to grow even faster at a 14% CAGR. Fortinet is planning on focusing on the universal SASE, but SASE is a secure access service edge, which is currently a $17 billion industry, but it's expected to grow at a 20% CAGR per year. Here we can see a segment breakdown for the company's billings, but billings is a key performance indicator for cybersecurity companies and is the value of invoices sent to customers, which is a forward-looking metric that helps us evaluate how the revenue growth will be in the coming years for Fortinet. And currently, 70% of billings is in secure networking, 10% in security operations, and only 20% in universal SASE. But like I said, the focus of the company is going to be growing into the SASE space. Here we can see the year-over-year change in billings, which was only 5.7%, which was one of the reasons Wall Street was unhappy with the company. Revenue growth was strong at 16%, but as we can see, it was much slower than the past 2 years. And another reason for Wall Street being unhappy with the company was their slowdown in product revenue sales, which was negative 0.6, having been quite high for the past 2 years. Their service revenue growth is, however, still very strong at 27%. Fortinet has incredibly high gross margins, which are pretty stable, hovering around 76 and 77%. Their operating margins are really strong as well, going from 25% 2 years ago to 27% for Q3. Net income has also doubled from 165 million to 323 million. And the company is also buying back shares, which is always good to see. Their deferred revenue is growing, which is their subscription revenue, which they've already received, but they can't book as revenue until they deliver the services. The company's balance sheet is pretty strong. They don't have a lot of long-term debt, and they have over 3 billion in cash. The management team has been ramping up the stock repurchases after having a couple of quarters without buying back stock. They bought back stock for 604 million, and this is a beautiful chart showing us the last 12-month adjusted free cash flow, where we can see the intrinsic value of the company growing at a very good clip. Now, this is a pretty interesting chart which management always puts into the investor presentation. This is a chart showing us the billings and revenue year-over-year growth rates and the operating margin from 2009 to 2023, and this is part of the rule of 40, which Fortinet defines as revenue year-over-year growth plus operating margin. So that means if the company grows revenue year-over-year by 20%, they want to have at least 20% operating margin. So as the revenue growth slows down to, let's say, 15%, they want to increase the operating margin up to 25%. And it's interesting to see that the company has been public for 15 years and has only missed the rule of 40 for 3 years in 2009, 2013, and 2017, which tells us how good management is at running the company and allocating capital. Now, we don't want to get myopic on the latest quarter, and we do want to zoom out to see the long-term performance of the company. It is interesting to see that between the years 2009 and 2013, their product revenue had a CAGR of 29%, 20% between 2013 and 2017, 16% between 2017 and 2020, and 28% between 2020 and 2023. And the 14-year CAGR, or compounded annual growth rate, since the company went public in 2009 is 23% for the product revenue, 24% for service revenue, and 24% for the total revenue, which is a very strong performance. I want to show you real quickly the reviews for Fortinet on glassdoor.com, which I think gives us a good idea of the company culture. They have over 2,000 reviews, with the company getting 4.1 stars, where 81% would recommend the company to a friend, and Kenzie, the CEO, has a 91% approval rate, which is, I think, the second highest I've seen on the companies that I've studied, with the only one beating him is Shantanu, the CEO of Adobe. The leadership team of Fortinet has quite a lot of skin in the game, where you can see the founders, Kenzie and Michael C., own over 15% of the company, which is something that we are always happy to see. The next thing I want to do is compare Fortinet to their biggest rival, which is Palo Alto Networks. If we compare the company's growth in free cash flow, Fortinet has a stronger growth in free cash flow for the last year, but Palo Alto has them beat for the last 3 years. But as we can see here, both companies have a pretty similar growth in free cash. The strategies for Palo Alto and Fortinet are very different, where Fortinet relies on organic growth to grow the intrinsic value of the company, and Palo Alto is very aggressive in acquiring other companies to grow. Now, personally, I like the organic growth method more, since I think it's more sustainable in the long run. And I do think overall Fortinet is a fundamentally much better company, at least when you look at the financials, but you of course have some quantitative factors as well. The enterprise value to free cash is much lower for Fortinet, and the PE ratio for Palo Alto is just off the charts. Fortinet seems to be a much better capital allocator, with the company having a much higher return on invested capital and return on capital employed. Both companies have similar gross margins, with the gross margins being pretty stable. Fortinet, however, has much stronger operating margins, which has been expanding for the last 5 years. The free cash flow margin is strong with both companies, and it's safe to say that Both Fortinet and Palo Alto are free cash flow generating machines. Both companies have pretty strong balance sheets, with Fortinet having a better current ratio and Palo Alto having a better debt to equity ratio. Both companies have a pretty high interest coverage ratio and a lot of cash in relation to their debt. Palo Alto has been diluting shareholders with all of their acquisitions, which is something I personally don't like to see. With the current decline in the Fortinet stock price, Palo Alto is now a much bigger company at a market cap of 78 billion and Fortinet at only 39 billion. Finally, I do want to show you my highlights from the earnings transcript. Kenzie talks about here that the company exceeded the expectations of Wall Street, both when it comes to operating margin and free cash flow. Now, I believe this is supposed to be billings, not building, but like I mentioned earlier, billings and product revenue fell below the expectations, and that was something that Wall Street was not happy to see. And Fortinet is responding to the slowdown in secure networking market by shifting their focus towards the more faster growing secured operations, which is the SASE market. But secure networking will remain a vital part of the company's strategy and a market that they believe will return to double-digit annual growth over time. As a part of their strategy, they anticipate that success in the SASE market will first come from upselling SASE service to their installed base of tens of thousands of AT1 customers, and also from attracting new customers looking to leverage a single vendor integrated SASE service solution. And they also say here that their industry leadership in both firewall and SD-WAN, the second largest component of SASE, provides the company with a significant competitive advantage. Like I mentioned earlier in the video, the company bought back shares for about 444 million in the quarter, but they still have a remaining share purchase authorization of about 980 million, which is good to see as long as the stock price is so low compared to the intrinsic value of the company. So to summarize, this was in my opinion a great quarter for Fortinet. Although they do have some short-term headwinds, the company has a great management team which has tons of experience and are probably one of the best, if not the best operators in the cybersecurity space. So I am confident that they will be able to lead the company in a sustainable growth for the coming years. And I do think that Wall Street has overreacted to some short-term problems. If Wall Street never overreacted to short-term problems, we would never get opportunities to buy wonderful companies at a fair price. But that's it for the video today. I do want to thank you for watching, and I will catch you on the next one.